Hey everybody, this is Jim Nelson, and this is another Euro Pacific market update. Thanks for joining us today. So we just released another update on our website. It's titled "Balancing Caution and Optimism: Navigating 2025's Market Dynamics." And the reason we put this piece out is that we've seen increasing risk to a potential correction in asset markets in the beginning of 2025 because of a few key items that previously we viewed as kind of uncertain or maybe a low probability of happening. Because of some of the recent economic releases we've seen, we think the probability of these items has increased. And so let me lay it out for you, kind of what we think about how 2025 will progress. We've mentioned in previous updates a lot that inflation remains a central concern. That's still the case for 2025. Inflation continues to show upward pressure, despite the fact that most economists and the media is reporting on the CPI number as being good today, simply because the core number looks like it's tailing off. That's not really our view. If you look at the 3-month annualized growth rate for all items less food and energy, so this is the core number, but if you just take the last 3 months and you annualize that, that's at 3.24%. It's much higher than the Fed's comfort zone. We also highlighted earlier in 2024 that energy was artificially low and would begin to tick up in the winter months. That's exactly what's happened. Energy services and utility gas showed sharp increases. We saw annualized growth rates of 4.47% there and 10.19% respectively for energy services and utility gas. Also, just the headline number, just the overall number for inflation is showing a 3-month annualized growth rate of 3.65%. This is much higher than the Fed's comfort zone. And given the payrolls report that came out earlier, that also suggests that the employment situation remains strong. This is getting the market quite jittery, and what the market has been doing in the beginning weeks of this year is pricing out another rate cut from the Fed in 2025. So previously, the market had expected many rate cuts. It had whittled that down to 2 rate cuts by the end of 2024, and now the market is looking for pretty much only a single rate cut. So really, in 2025, we think the Federal Reserve stance is likely to change. Okay, they're not going to be able to continue to be as dovish as they were in 2025, where it was really a story of rate cuts. Now it's going to be a story of less rate cuts, and then potentially later in the year, even tightening. We don't know. Obviously, the Fed wants a soft landing. They don't want to go that direction. But if the employment situation does not give them cover moving forward, we think that they're likely to turn more hawkish. And when the Fed turns hawkish, what happens with the yield curve is it's generally going to shift higher, and a higher yield curve is bad for global liquidity. And what's bad for global liquidity is bad for asset markets. So we're seeing inflationary pressures continue to grow. The market and the Fed are beginning to identify that as something that is likely to happen. We're seeing a relatively tighter view on monetary policy, and that's one of the reasons that we become a little bit more cautious in the beginning of 2025. Another thing that we're looking at really is the potential implementation of tariffs by the incoming administration. We think that if you've looked at the performance of the dollar in the back half of 2024, it was incredibly strong. Okay, and we think that trend could continue at least over the short run as the incoming administration gets going on their agenda with respect to tariffs. Previously in history, what we typically see when tariffs are introduced on a trading partner of ours, they will devalue their currency. If they're devaluing their currency, it continues to push the dollar higher. One thing that we know about the dollar is it pushes higher, it puts a strain on global liquidity, and if we're putting a strain on global liquidity, that's also puts downward pressure on asset markets. Meanwhile, we think that the economy will likely continue to moderate yet outperform the market's expectations for growth. So we think it's going to do better than expectations, but it will moderate. So if the economy continues to outperform in the US, and this would really be driven by consumers just having a lot of cash on their balance sheets from huge deficits that were run during the COVID pandemic. Also, just the government running one of the largest pro-cyclical deficits we've ever seen, which is necessitated by non-discretionary items, and in addition, growing interest costs on the national debt. If we continue to see large pro-cyclical deficits from the government, if we continue to see a consumer that's insulated from higher interest rates, has a large cash balance, can potentially continue to lever up, we should see the economy continue to at least outperform where we see expectations right now. That puts the Fed in a bind. It can't really focus on the economy either. And so we think that that could continue to put support under the dollar, at least in the beginning of 2025. So these factors all come together to suggest that we could see a strain on global liquidity in the beginning of 2025. It could impact funding markets, and that could have some negative implications for asset markets. So on the margin of turning a little bit more bearish, we think it really makes sense in the first half of 2025, first quarter of 2025, to remain cautious as an investor, stay diversified, but be ready to buy that dip, because over the long run, we still remain fundamentally bullish. We think that when we see volatility in the market, the Fed will respond with with a dovish tilt. We also think that the incoming administration will be able to push through tax cuts and other things that will improve the global liquidity situation going out of 2025. So any sort of volatility or sell-off in the markets that we see early on, we should view that as a buying opportunity. So fundamentally, we remain very bullish going forward. We think that investors should be focusing mostly on inflation-protected assets, which is what we specialize in here at Euro Pacific Asset Management. That pretty much concludes my update. I hope that you've enjoyed the information that I provided you here. If you want to get a little bit more detail, a little bit more information on the arguments that we're making, you can take a look at our piece on our website, europac.com. And if you're interested in looking at how we can help you with your portfolio, please reach out to an advisor. You can find all the contact information on europac.com. Thank you again for listening, and we'll see you next time.